This is Kevin Kleinman, owner of stockhaven.com and head trader at watchhimtrade.com. This will be a video outlook on a couple stocks for the week. I'm going to cover BIZM, a penny stock. I'll cover Apple, Amazon, and then SPY, general take on the market. I'll do BIZM first for my penny players out there. So BIZM, ticker BIZM, this is a stock that is definitely one of the most followed promotions right now. A couple things I like about it, the reason I'm covering it. Number one, volume, liquidity. You just look at this volume here recently. Friday traded 4 million shares, day before 2.3 million shares, 10 million shares. So whether it's wash trading or not, or how much of it is real, not too concerned about that because all penny stocks are going to have some sneaky stuff going on. The key thing is that there is liquidity there. There is good volume to be trading with. And first thing I want to point out here on BIZM, if you look at this trend, there's something that all of these up days have in common. So started trading late May 28th, but the volume really started ramping up June 3rd. Started trading 2 million shares on June 3rd, and hasn't traded less than 1.29 million shares since that day. And on average, it's been able to trade 2 to 4 million shares. So if you look though, each day since May 28th, you've been putting in a higher low and a higher high. June 3rd, your low 148, your high 155. June 4th, 154 low, 160 high. June 5th, 159 low, 166 high. June 6th, 163 low, 173 high. June 7th, 169 low, 178 high, so on and so forth. All in all, you have failed to go below the previous day's low since the trend started. And on June 12th, for the first time, you put in a high that then wasn't followed by another high on June 13th, a lower high. However, on June 13th, that lower high wasn't accompanied with a lower low. You had a 281 low versus the previous day's low of 265, keeping the higher low pattern intact, where then on Friday, you reasserted that higher low, higher high by going above Thursday's high and staying above Friday's low. So this chart is very, very clear on what you should be watching for from a daily trend perspective. As long as BIZM can avoid going below the previous day's low, then this trend should remain pretty much uninterrupted, and I would be betting on further upside. Obviously, if you've been able to catch this move thus far, you should have already locked in some profits at 100% gains, but it's not necessarily greedy to be holding for more because the chart still points at more upside. The level I would be trading against, whether I'm in the trade now or looking to get into it on Monday, would be 295, as that's Friday's low. So I would look to get into the trade and put a stop loss at 294, with the thinking that if you go below the previous day's low, which is going to be 295 come tomorrow, that represents something BIZM hasn't done over the last 13 days, which we know have been bullish because of the price increases. And anytime you have a bullish trend at play, not only do you want to look for what has happened to continue to happen, but you want to be on the lookout for what hasn't happened. And that is a way of identifying red flags, kind of by process of elimination. This hasn't happened, this hasn't happened, this hasn't happened. If it starts to happen, now I know maybe there's a different trend in play. I need to be cautious and kind of wait for more signals. I'm not saying BIZM can't go below 295 tomorrow and then not continue higher. What I'm saying is that if it goes below 295, from a risk-reward perspective, that simply represents a potential change I would not want to be in while it figured out what it might do during that time. However, excuse me, however, at 312 versus that 295 low, though, you're looking at a solid risk-reward entry where the stock is only about 5% above from that stop loss of 295. So that's on more of a daily swing target approach. Now, if you just take a look here at an intraday 5-minute chart of the last few days, let's look at a 15-minute chart. If you look at a 15-minute chart, what you'll see is that BIZM hasn't gone below that initial 15-minute low by more than a couple cents. So that's another thing to watch for. So here you're looking at June 10th. Your initial 15-minute low is 175. That's from 9:30 to 9:45. And then your 9:45 to 10 o'clock low was 173. So it was only 2 cents lower. In other words, couldn't build much momentum below that first low of day from the first 15 minutes of the day. Ended up rallying. Similar situation on the 11th. Your initial 15-minute low, 223. Your next 15-minute low, 222. Again, yeah, it broke it by a cent, but it couldn't build any type of momentum below that low. Keep on going here. And now you look at what your initial low was. $3 on June 12th. Again, it held it. But then later in the day, it started cracking below that initial 15-minute low here at 10:45, and that did signal that it was going to pull back further on the day. Whereas then you go to Thursday, initial 15-minute low, 281, never really pulled back below it at all, didn't even test it. And then Friday, initial 15-minute low, 295, and you never came down to it and tested it. So what also I would say on BIZM is you want to, at 9:45, 15 minutes into the day, you want to look, what is the low of day? Mark that low of day level. You don't want to see BIZM go more than 2 or 3 cents below that first low of day, because if it does at any time throughout that day, then as shown on Wednesday, June 12th, that could have bearish implications because the price dropped from $3 all the way down to $2.65. So you would definitely want to protect yourself. So those are kind of two things to watch from a daily and intraday perspective, that if they occur, you want to be on the lookout for a drop lower. If those two things don't happen, then this stock's in good shape. You've got this high at 330 from Wednesday, above 330, 350 is the next level that makes sense, and you can easily trend higher to $4. But continue to watch out for those two things: going below the previous day's low and or going below the initial 15-minute low by more than 2 or 3 cents at any time throughout the day. Next, I will analyze Amazon. So Amazon is a stock that for a good portion of the year has just been kind of in a wide channel. If you look, the first day of the year, Amazon's low was 253, and got all the way up to 280 or so, but never could really quite stay there. And for the most part, it has respected this channel with a brief move above it in late January and a brief move below it in early May. But now what's interesting here on this pattern is it is holding up close to the top end of the channel, and this break above the channel hasn't resulted in a hard move lower. compared to this break above the channel in late January that resulted in a hard drop from 280s down to 260s. This time you moved up towards 280, and yes, you pulled back to 270, but you bounced off 270 and now you're holding around 273. So to me, it's pretty simple on Amazon. Last week's range gave you a nice reference point in that 270 level, where as long as you're holding 270, now Amazon is on the verge of pushing out of this channel and possibly raising it. And if you attribute a new channel developing from a bottom and base of 270, and you consider that the channel low used to be 253 and the channel high was about 280, 284 or so, and you apply that to a bottom of 270, so you say, all right, let's take this high here at 284 minus this first low from the year at 253, and that's a $30 channel, $31 to be exact. We'll just keep it at 30 for simplicity. And you say, all right, there's a possible new higher channel low at 270, and we add that to our existing range. That would take Amazon right up to 300 bucks. So my projection would be that should Amazon hold 270 during any market weakness that might play out, then 300 is a likely destination going into the month of July. This move took, pretty much the entire month of January. So here we are, middle of June. If you hold 270 this week, to me that sets up a move into that 300 psychological resistance level come the first, second, third week of July, somewhere in that range. 270 is really the key. What happens if you break back below 270? Well, you have these lows here right around 265, and then these lows here at 258. And really, it wouldn't be a terrible thing, but Amazon would just kind of be at risk for falling back into that regular channel, pulling back deeper towards 260. So 270 is a nice simple level that from a risk-reward perspective, I believe you can go long. The closer you get to 270, that's where I'd be looking to go long on Amazon, using that level as a stop. And the breakdown below 270, if that should play out, then I would target a move on down to these lows, around 265, on down to 262. Below that 265 level and really 250 to 260, a wide range comes back into play. I know that's a wide range to give, but given the way Amazon's channeled all year, it's been very capable of moving $5, $10 pretty easily. The one thing I do like on Amazon is so far in June you haven't had a 3-day losing streak. And if you look at this move that occurred in the last week of May, just about from May 22nd up to May 24th, you had this 3-day losing streak following an approach of this resistance level, and now you look at where Amazon's pulled back to. It's been managing to hold that previous resistance, so a possible case of resistance turning into support now. And just overall, I like that it's avoided that 3-day losing streak, something it wasn't able to do the entire month of May. And if you look from a monthly perspective, it's going on its first 2-month winning streak since August, September of last year. So that break-even point is 269.20. So maybe instead of 270, you focus on that 269.20 level, as that is the red to green pivot point for the month. And it's working on its first 2-month winning streak of the year. First back-to-back green months, it would be since August and September of 2012, dating back to last year. So that's another positive sign. So watch that 269.20 level, as that is the break-even point on the monthly chart. to kind of usher in some more momentum if Amazon's able to stay green. So really 269.20 to 270. Also from a monthly perspective, you broke above that previous month's high without going below the previous month's low, at least so far. And that would be the first time you've done that since the first month of the year. So really on Amazon, simple setup. You start drifting below 269.20 and those 250s, low 260s are back in play. You hold it and 300 will act as a magnet and pull this thing above that 280 to 285 resistance level. Next stock I'll cover is Apple. And I'm going to do Apple kind of long-term to short-term, a little backwards, because I want to point something out that most people aren't aware of. They haven't taken the time to research, but I have. Apple just had a 3-month winning streak. You wouldn't have believed it if you just guessed it, but it actually has. It was green for the month of March, April, and May. 3-month winning streaks are very, very common on Apple, dating back to 2005, as a matter of fact. Every time Apple has had 2 green months in a row, it's went on to have a 3rd consecutive green month. On average, that 3rd consecutive green month has been a very strong month, averaging a return of 13% with a low of 6% and a high of 22%. I've done the numbers. You can go back and check. Since 2005, I believe there's been 9 instances where Apple has rallied 3 months in a row. That 3rd month returns. So for instance, 2005, August 2005, it closed at 46.89. That was its 2nd up month in a row. And then September closed that next month at 53.61. So that's what I mean by kind of following a 2-month winning streak with the 3rd consecutive up month. If you look at what just happened though, this 3rd month return versus the last month was the weakest return ever recorded in the last 10 years. To me, that's a red flag right off the bat. So now you break it down, you look at the daily chart, you've got a stock that is making lower highs on a daily basis. A lot of people would like to think that this stock is bottoming. I'm not one of those people. I believe it's pausing its downtrend and it's about to reassert its downtrend. It would take a break above the previous lower high to eliminate that view from my mindset. So if you just look here, you can see them clearly. February 11th, put in a high, 484. March 25th, put in a high, 469.95. May 7th, put in a high, 465.75. May 31st, put in a high, 457.10. 4 lower highs in a row. You can connect this downtrend here, and you can see that Apple has respected this downtrend even with the brief attempts above it. More importantly than this downtrend, however, is the uptrend that is no longer in place. Off of this 385 bottom, Apple had a decent uptrend going. However, that uptrend gave way most recently in late May, and you have since been downtrending further. Okay? It's really, really simple on Apple in my opinion. 420. That's what it's all about. If you break below 420, this thing is going to tank. If you break below 420, it's going to tank. It's going to retest this 385 bottom and likely going to break it and go even lower, probably towards 350 in my opinion is where it might have some support. I'll break it down a little further though because you don't want to get overexcited in trading this name, at least not yet. Why? Well, volume's very, very, very low and it's in a channel. And when something's in a channel, breakouts and breakdowns can take a long time to fully materialize, and they can leave a lot of people frustrated and impatient. The play on Apple, though, in my view, is to expect a channel bounce from here because you are near the low end. Now, if you look, though, the channel keeps dropping lower and lower. First, you had a little channel from 455 up to 465. Then you broke that support, came down into the 420s, retested it, held it, and started bouncing up. And you could see a channel from about 435, to 445. And then that channel got bumped up from 445 to 455. However, since you've come back below 450, this channel's gotten lower, with 445 on the top end and 435 had been providing support. Now you finally registered a daily close below 435, closed right at that 430 level. My expectation now is for 435 to be resistance. I want to see, from a bearish perspective, Apple get rejected at 435 on any bounce attempt that happens this week. Below 435 and the path of least resistance is lower, and 420 is in play, and that's the test that I would expect to come. Above 435, and it gets interesting. Above 435, and you could retest these, what are now key resistance levels, between 441.25 and 442.75, the two daily highs of June 11th and June 13th. If you're just looking for a simple way to play Apple, it's put in a lower high 5 days in a row and a lower low now 4 days in a row. So just watch for that pattern to not play out, where if you put in a higher low tomorrow, then maybe that's setting up for you bounce. Or if you put in a higher high, same thing, might be setting up for that channel bounce. The thing I want to talk about further, though, is volume. Look how low the volume has been during this fall over the last 4 days on Apple. What are the implications of that? Well, we're in a low demand, low supply environment. I can make that statement and believe that it's true because volume is extremely low relative to average. 4 days in a row where you haven't gotten above 11 million shares. That's the first time that Apple hasn't been able to do that, similarly, since April 11th to April 16th, which, oh, look at that, preceded a huge drop. Now, the problem with such low volume and declining prices, what it means is that even on very low supply, there's even lower demand, because we know that prices fall when supply outweighs demand and prices rise when demand outweighs supply. So when a price is able to fall on very low volume, that tells you that even on very low supply, there's even lower demand, which is resulting in that price decrease. The implications of that are, if volume picks up, if supply picks up, there is not going to be any demand to keep this price from dropping very, very dramatically. I can say that and believe it because I've already seen evidence of it over the last 4 days. Whereas on the opposite side, I can't say if demand picks up, then the price will rise dramatically. I can't say that because even in a low supply environment, on the day when it was green this last week, June 13th, it was only green by a marginal account, by less than 1% on the day. So the signs point to supply outweighing demand, which means that if volume picks up, I'm going to leave my benefit of the doubt on the supply side because that's the evidence that is supportive right now. It would take a major price rebound on high volume for me to change that view that now demand is starting to outweigh supply. Other thing I want to touch on Apple here is this inverse head and shoulders pattern, which is getting a lot of attention. This is a potential bottoming pattern. You have the left shoulder on March 4th, the head in the middle of April, and then the right shoulder on May 15th. Now, I don't know about you guys, but I've never seen a shoulder that goes this long and bends in that many directions. I'm not falling for that inverse head and shoulders pattern. What actually appears less obvious to me is a head and shoulders topping pattern. You have your left shoulder here, your head here in March 25th. Your left shoulder was that right around February 11th. And then your right shoulder May 7th. Now, some people would say, well, the shoulders come higher than the head. Well, if you research some technical analysis, you'll see that the height of the shoulders is not particularly relevant when it comes to determining a head and shoulders pattern. So, to me, what I see is a head and shoulders topping pattern where if you break below 420, which would be the neckline, that confirms the head and shoulders top, and that then would project for at least a $40 move lower based on the amount between the neckline and the head. 420 down, 420 up to 470, so sorry, a $50 move lower, so that would take you down to at least 370. So if you break below 420, you've got a big support level at 400, that would be the other level, but I don't understand why anybody would step in at 400 on a stock that, you know, is coming so close back within its bottom. And then you've had the 385 level, and then 370, and then 352.50. Why 352.50? That is the 50% retracement of the 705 all-time high on Apple. 352.50 is where I could see Apple finding itself if it breaks below 420. The important thing, though, to remember is volatility has been low on Apple. It's just been channeling. Not a whole lot going on. I want to wait for a volatility pickup before really getting aggressive. Other than that, I would just keep playing the channel that's been putting in lower highs. So 435 on the upside, now maybe we bump it down to 425 on the low side and we bounce around there a little bit. However, if you break below that 420 level and volume does come in, then that's when I would start to get aggressive and target a really deep move lower, because the problem for this stock is not only will you have all the bag holders still from up here at 600, 700, 500, but now you'll have a whole new wave of bag holders of people who bought in anytime over the last couple weeks above that 440, 450 level, thinking that they, you know, the stock had surely bottomed. And then it becomes a question of who the hell is going to buy this thing? Why are buyers going to step in when this stock just can't find its footing at all? And if you think about that, off of 385 up to 465, it rallied 20%. If it comes back down to 385, we'll have given up all of those gains. That would be treacherous for this stock. So keep your eye on Apple. I feel like it's kind of under the radar right now. People think it's bottom. That's the sentiment. CNBC had a bottoming article on it. New York Times, I've seen, wrote an article on, on the fact that the bottom is in. So to me, I don't think a lot of people are prepared for a potential retest of that 385 level. The important thing, though, is not to anticipate. While I'm guessing it can break 420, I'm not going to anticipate it. I'm going to continue to trade this channel, knowing that, okay, if 420 breaks, now I'm good to go on some of my more extreme bearish targets. But don't want to caught betting on extreme downside when really all it's doing is still channeling. So watch 420. Long as you're below 440, that keeps this downside expectation in check. Get above that 440 level. Now you start thinking, okay, maybe we can rally back above that 457.10 high, break that streak of lower highs, and it can get back on its way, and the bottom is indeed in. However, at this point, closer to that 420 level, so I favor the downside. That can change, have to be open-minded to that, but until I see evidence of it, meaning a rally back above 440, I'm not going to change my expectation, and I'll continue to guess for more downside. Lastly, I will cover SPY, which is the ETF that tracks the S&P 500, just with a general take on the market here. First thing I want to talk about relative to the SPY and the market are these 3 days right here from June 10th through June 12th. On June 10th, SPY opened 165.30, closed at 164.80, closed below where it opened. June 11th, opened at 163.30, closed at 163.10, closed below where it opened. June 12th, opened at 164.20, closed at 161.75, closed below where it opened. Why am I making a big deal out of this? Well, it was the first time all year that SPY closed below its opening price 3 days in a row. If you look here on these 3 days, yes, they were all red days. However, on May 23rd and the 24th, both days, even though they're in the red, SPY gapped down and actually was able to close above its opening price. So the key is recently that gap downs used to be buying opportunities, dips used to be getting bought. Now, after that 3-day stretch of closing below its opening price, that kind of signaled a willingness by market participants to actually sell that move lower and sell that attempt at a rally higher. As you can see, on June 11th, opened 163.30, got as high as 164.50, but ended up coming all the way back down. You know, they sold that attempt at filling the gap. So keep an eye out for continued weakness in that respect. Be marking the opening prices on SPY and seeing, you know, come the last hour of the day, are we above the opening price, below the opening price? If you're on pace to close below that opening price, could get some decent momentum to the downside. From a support and resistance perspective, most recently, SPY has entered a channel. Okay, where your low is right around 161 and your high is right around 165. Right now, 162.90s, you're pretty much in no man's land within that channel. I would play the channel on SPY until a breakout or breakdown occurs. So at this rate, you're on your way back down. Would just be guessing on more downside. But then if you start reversing, now you're on your way back up. Target that channel resistance right around 165. So at a midway point like this, between 161 and 165, you know, 163 is that midway point. So really just kind of watch over under 163. Are we below 163? If you are, then I'd be targeting that channel downside towards 161. If you're above 163, that's the case where then I'd target that channel upside near 165. Until you get kind of back-to-back movements on the daily, either above 165 or below 161, all SPY is going to do is channel. If you do break above 165, though, on a back-to-back daily basis, then I would target these all-time highs at 169 on up to 170. If you break below 161 on back-to-back daily, on a back-to-back daily basis, though, then you have this low at 159.78 from the gap up above 1600 on the S&P. That was from May 3rd. That's where I would target initially. Below that, and the 157 and 158 range can get tested. If you just look at the SPY overall, you know, since its November lows, you can see there's a nice uptrend in place. That dates even all the way back to August 2011. While that is good that there's an uptrend, the bad news is that SPY could fall a long ways without even coming back down to its uptrend line, which means, you know, there's a lot of lower levels that could get tested maintaining its uptrend. So it's always good to have a lot of support below where it's at, but that also leaves it somewhat exposed to a severe move lower. And then if you look even more recently, just on the daily chart, you also have an uptrend here off of these lows, and that is the one that is currently being tested. Give me 1 second here, plot this correctly. So if you just kind of look at this uptrend line, I don't know why it's not showing up like it should be. All right, well anyways, you're going to have uptrend support right around that 161 level going into this week. So really important to just kind of hold that channel low, as that channel low that I was looking at is also in line with where the uptrend is. Now, the last thing I want to touch on is the VIX relative to where the SPY is at. Because you've got a VIX that's up here at 1714. And if you look at the last time the VIX was that high, it was in April, mid-April. And if you look at where SPY was during that time, SPY was right around 155. So what's interesting to me is that you've had a rise in volatility without an accompanied inverse drop in the SPY itself, in the market itself. What that implies to me is an expectation, a severe expectation of a ramp up in volatility. Now, what that indicates is that, number one, since it hasn't happened yet, since the market hasn't moved lower, you have a market that's kind of shooing off what the VIX is saying. The VIX is saying that volatility is coming, but because the market is a full, 100 points higher than where it was the last time the VIX was up here, it's essentially telling the VIX, we're calling your bluff. We don't really believe you. So the implication of that is twofold. Number one, there isn't a big rise up in volatility. The market doesn't get shaky. It doesn't drop below that 161 level. This VIX is going to implode. It's at 1715. The VIX can drop a long, long ways back on down to this 12 to 13 area. However, if the VIX maintains its perch up here around 17 and the S&P does drop below that 1610, 1600, 161 SPY level, then now you have a market that didn't react properly to what the VIX was signaling. Now it needs to play catch up to that already increased volatility. Things could get very, very, very shaky, and you'd have a market that's especially vulnerable to a 50-point down day in the S&P or 200, 300-point down day in the Dow. Again, that is a scenario that I believe plays out if the VIX holds up here above, that 15 to 17 range, and the market, the S&P, then breaks below these most recent lows that I was talking about on SPY. Right around 161 has been the channel. If you look at the S&P where that is, it's 1610 on down to 1600. So bottom line that I'm saying here is SPY and the market in general is in a channel right now. If you break above 165 and get some follow through, the VIX is going to implode. It's going to move a lot lower. I would look at puts on the VIX and calls on the market in general. I would target a move to new all-time highs. If SPY moves below 161 and the VIX is up here above 17 and then pushing above 18, this market could unravel big time because it would be testing that uptrend line, possibly breaking it, where then you could easily see SPY falling from 161 on down to 158, 159, and then below 158 or so, these 153 to 155s are quite vulnerable. So just kind of watch this channel, play this channel for now. If it resolves itself, go in that direction and keep an eye on that VIX. Again, this was Kevin Kleinman, owner at stockhaven.com, head trader at watchhimtrade.com, with my video outlook on BIZM, Amazon, Apple, and SPY. Thank you.